Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and crystal ball gazing. Today is Wednesday, October 30th, 2024. Today's episode, we begin talking about the 4-month 20-year reversion. Most people are familiar with the 2-year and 10-year differential between those two year yields. When the 2-year is higher than the 10-year, it means that conditions are expected to stay tight, that the Fed is going to try to slow down the economy. That's the intention of having the closer end higher than the longer end. And recently we uninverted, suggesting that we are closer to a recession than we've been in the past many years now. The other spread that people typically watch is between the 3-month and the 10-year, again because of the amount of business borrowing that happens at the 10-year and the closeness of the 3-month having it's far out enough from the Fed funds rate to show where we're going, but not so far out that it's bound to change very much. But again, as we get closer to the 3-month in this cutting cycle, and it becomes obvious that we still have those next cuts coming in, the 3-month yield will be dropping little by little, day by day, unless the market starts sniffing out that the Fed will not be continuing to cut. As it stands, we're headed in that direction. Anyway, I bring up this chart again because the 4-month, for the first time today, is now below the 20-year. It is 4.57 to 4.6, so it's now below it. It dropped below it by 3 basis points, or 0.03%. By this metric alone, it is finally more expensive to borrow at 20 years than it is at 4 months. Just yesterday it was the opposite. And we call it reversion because it's going back to a normal state. Because when you lend anyone, even the government, money, you expect typically a higher rate of return with a longer dated treasury or any bond. If they're going to borrow it for a longer time, you're taking a higher risk. And time costs money. It should not be long before we get to the point where the 3-month and 10-year revert. And if history repeats the way it has pretty much every single cycle, it means that monetary policy went from strangling the economy to now trying to help the economy move forward. And as the economy is a big ship and doesn't turn right away, like I've said in other shows, like a go-kart, you don't turn it and immediately turns. It's typically you turn it and then a year later it starts turning the other way. So that's why you typically get that recession or depression after the reversion stage. So we're getting closer and closer every day. And this part is another piece, the 4-month, 20-year now reverted. GDP for quarter 3 came out at a very healthy 2.8%. So July, August, and September, by this metric, we were not in a recession according to this data. And typically when you get revision of GDP, it doesn't typically really ever change more than 0.2%. So it could drop as low as 2.6. But however you want to look at it, this is not yet a weak number. Again, this is looking backwards. This isn't seeing what's ahead. And so it's important to realize that, we're halfway through quarter 4, about 1 month left of it. And then we're in quarter 1 of 2025. 2 months away. So we're a third of the way through quarter 4. Any which way you look at it, this is looking back at the previous quarter. So, yeah. So even though we had the SOM rule triggered, GDP is saying, yeah, we're not in a recession quite yet. Tomorrow, look out for PCE data. Also, still a few big earnings reports coming out. Nothing really shook market so far this week in terms of the job openings, the GDP, or anything yet. So, who knows? PCE might be a doozy. Friday, unemployment, the employment report might be a doozy. Yeah, we'll know when we get there. All in all, it's turned out to be a surprisingly mild month so far, or a week so far. I expected more volatility, as did the VIX. We'll take a look at that in a second. These are the daily reminders. Watch my separate daily reminders Monday show to see me walk through all of them. The way I look at it, it's very scary stuff. So the crystal ball reading remains that there's a bear market coming very soon, and I also believe the Fed won't cut fast enough to save the economy. So nothing as of today has changed in the daily reminders. I will update anything that changes on a daily basis. I very much appreciate all the views and all the support. Feel free to support the channel as you please. On to the charts. We'll start with the SPX, the S&P 500. As you can see very clearly, I said flat out I have a crystal ball, and I said this week was going to be crazy volatile, and the S&P 500 just not caring, just going straight flat. Granted, we did break down to the downside out of this upsloping wedge. So all signs still point to us rolling over to the downside in the immediate future. But as of today, still just floating sideways. The VIX, the fear gauge, the way we price options contracts, the VIX futures term structure shows that we still are in fear mode, a lot of fear. The current contract being above the entire rest of the curve all the way out through June. Again, time costs money. And so for it to be this elevated right now suggests that this market is yelling, we're not out of the woods yet, folks. Mr. Market in, the driving the S&P 500 down the road is a little sleepy, like, oh, what's going on? And the guys on the radio are saying, hey, there's some trouble going on. And Mr. Market doesn't seem to care yet, but the VIX is saying something. It's sniffing something out. And it's not just something. It's elections. It's all this data coming out. It's the employment report coming out on Friday. I could see the VIX cooling off after Friday if the employment report doesn't really shake things up. After this week, there's not as much monumental data. This week was the monumental week. So, see how the rest of this week plays out. The 10-year Treasury note caught my eye today, and I drew some new lines on this chart showing an upsloping wedge that it looks like we broke out of and are underneath now. And so from this standpoint, it does appear that yields are sort of set to cool off. Again, if we want to see for sure we're going back down, we want to see a close below the low of today at 4.2. If we see that, for example, tomorrow or the next day, we will expect yields to continue lower. If that happens, this is again, I'm assuming most of my viewers know this, but when yields go down, the value of bonds goes up. And so something like TLT, long duration treasury bonds, would do well if yields drop. I personally have a ton of exposure to long duration treasury bonds. Over 50% of my own portfolio is exposed to this and benefits if yields drop. Sorry if you're hearing this for the umpteenth time, but when yields are over 4% and the S&P 500 has a PE ratio of 30, that doesn't make sense. Either yields need to go down or the S&P 500 needs to go down, or both, so that you get that equilibrium between the valuation of stocks and bonds. So it should not be surprising if this falls from here. If it rises from here, I will be getting more exposure to long duration treasury bonds at this point. Another clue that may suggest that we've peaked in yields actually is the move index. This is the volatility of bonds, of the bond index. And as you can see this chart, we had spiked up and we're going flatter and flatter. It's almost looking like it's going to roll over here. And when the move index goes down, typically that's bullish for bonds. Next chart that I want to bring up is actually gold to the US dollar. I haven't I've done a few specials on gold in the past. I haven't brought it up much on the show. I should bring it up more because it is an important asset class. It's been around for, I don't know, tens of thousands of years, used as currency, used as, the real money. One thing though that I really can't stand is people trying to make the claim that gold is somehow smarter money than other money. If you look at gold's history, gold has had plenty of periods where it's just gotten way out of hand. It's gotten way too expensive. And then it's had periods where it's gotten too cheap, just overly cheap. I don't agree with a lot of gold bugs out there that are always just pounding the drum and saying gold, gold, gold all day and saying, we don't price gold in dollars, we price dollars in gold. That gold's really the stable thing and it's dollars that are moving relative to gold. Yeah, not really. When you have to take the fact that you don't go to the store, you don't use gold. Do you? Do you go to the store with like a bunch of gold coins to buy your groceries? Do you use gold to buy oil? Do you use gold at all? Does it have any utility in your life? It doesn't for me, and it doesn't for really anyone in the entire world except for maybe, central banks themselves. If there was really a concern for the dollar collapsing because gold is going higher, well, what do you think? How do you think all of the rest of the world's currencies would be acting? And the thing is, like, every other country in the world, people get paid in their own currencies too, which are most definitely weaker than the dollar. And so this whole fear of the dollar, running into gold, like, if that's what you want to do, go for it. But just know, the important message to say out there about gold is that gold has its mania phases and it has its discount phases compared to the value of the dollar. And right now it appears to be in a mania phase, which means it's expensive to the dollar, which means I'm a value investor. I want to find things that seem unusually cheap, not things that seem unusually expensive. And so I don't like gold right now, but I'll watch it and I'll take note as to what's going on again. And I don't chase momentum. Some people, they're like, oh, it's going up, so it's getting more popular. So, I buy it. And then, you just find somebody and you say, okay, here, I'm going to give you this gold. You give me $100. Okay, you make the change. And they say, oh, here, I'll sell you that back for $101. And you just go back and forth. And you're like, hey, we have $1 million worth of gold because we're trading it back and forth. Eventually that ends, by the way. Eventually it ends, and usually it ends badly after you have a parabolic move to the upside, but I digress. While I'm beating the drum arguing against gold continues to press higher. Again, it's just I have no reference as to where the top will be, which is why I can't participate in gold myself. And from a historical standpoint, it seems pretty expensive. But yeah, all-time highs today. We are now at $27.87 per ounce of gold in US dollars. If a run to safety is like valid, then, because the dollar is going to be dropping in value, well, you would expect crude oil to be going up in price against the dollar too. And as you can see, the price of oil is not showing strength here at $69 a barrel. Just to remember, in 2022, we had gotten all the way up to $130 a barrel. And so we're almost 50% lower than that peak. Oil is, and the thing is, do you use oil? Yes. Do you? When I remember there, I just talked about you don't use gold. You don't have, your pocket full of gold and going using it every day. But if you're watching this video, you probably use gold on a daily basis. They turn it into gasoline. It fuels your car. It also likely is involved with partially, at least, in the production of the electricity that you use to charge the phone or device that you're watching me on right now. And the price of oil it's low. It's going down. It has been going down for a while, and there's no strength here. So this whole gold to the moon because inflation is going to be really bad is nonsense to me. Last chart of the day, if you remember yesterday and saw AMD today, one of the semiconductor companies, along with MicroStrategy, but that's a little different why that company had been dropping. Surprisingly, SMH, the semiconductor industry, is still stuck within this large engulfing red candle, which still suggests it is most likely to break to the downside here. And then we have this rising wedge that starts at the August 5th, 2024 down here. And we haven't really broken out of this wedge yet. I expect it to break out of this very soon. And if we do, we could head down to this neckline here of a head and shoulders top, sending the value of this much lower. I still am holding SOXS, triple leverage short of semiconductors. I keep saying on every show, trees can grow tall, but they don't grow forever. This is being priced like it is going to grow forever, and all signs point to this breaking down here. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.